Welcome to the Money Show. Warren Ingram is the financial advisor. He's a director at Galileo Capital. He's a certified financial planner. He is a master of all of his trades and contributes to the Money Show on a Thursday night. Before we get into what we want to talk about, BHI Trust. It's this investment vehicle that has gone down in flames. The operator, the fund manager, has confessed and has admitted wrongdoing and is sitting in jail trying to get away from the people whose money he has lost over the last 15 years. His name is Craig Warriner, probably 2 and a bit billion gone. What should investors have noticed was wrong, Warren? It's too late now for them, but we want to make sure that nobody else gets caught out.
I think it's there are a few red flags, Bruce. One of them is your investment. When you're going to put money somewhere, you need to know that it's regulated and registered with an appropriate body. So, for example, if you're going to put it with a bank, you need to know that it has a banking license. You go and look on the Reserve Bank's website, and you can find all the banks there. If it's going to be a unit trust, you go onto the ASISA website, and you can see all the unit trusts there. And if someone says to you, the money you're going to invest with me is going to go into XYZ unit trust, simply go and check. Make sure that it is a registered unit trust. And so you go with all of these investments. In this instance, one of the red flags is, does it have an FSP number? And so financial services provider number, because that means it's registered with the Financial Sector Conduct Authority. That's the regulator that looks after all of us, that give advice and manage investments. And if it has an FSP number, it's no guarantee that that means that it's completely above board all the time in every aspect. But it's certainly a red flag if someone wants to take your money and doesn't have an FSP number, doesn't have a bank account or bank license, or isn't a unit trust. You need to start asking some serious questions. The only other entity I can think of, for example, would be a stockbroking company, and you can check that with the JSE. So maybe the first one is, trying to find information on this was really hard. I know it's a news story, but gee, there's so little information about actually finding anything about the investment, and that's a red flag all on its own. Who is this guy, and what's his history, and who did he manage money for before? All of those things are just hard to find.
It's got tones of Jack Milne and the PSC Guaranteed Growth Fund because there was lots of noise about it at the time. This was 20 years ago. Jack Milne was sort of round-tripping money through a couple of listed companies, all connected to two people called Sue Bennett and Gary Porritt, who are yet to be convicted for any crime. But I certainly know Gary Porritt has been sitting in jail for a while, can't get bail. But Jack Milne was running the PSC Guaranteed Growth Fund, and there was absolutely zero disclosure. It was the days before unit trusts had to disclose what was inside them, and that particular scheme led to the evolution of the regulation as we see it today, where disclosure is compulsory in retrospect. You can't give away the family secrets up front, and it's got remnants of that, and it's got remnants of Madoff, and it's got remnants of people getting sucked in, and not even sucked in by anything particularly exciting or compelling. Not being sucked in with Bernie Madoff type returns, but some fairly modest returns, I'm told, of between 8 and 10% a year, which seems safe and easy. And so maybe that made people feel secure. Maybe he's a charming fellow. Maybe he is a slick salesman. I don't know Craig Warriner at all.
I think that is the other red flag. When you find an investment that is delivering, so let's just talk about 8 to 10%. At the moment, when interest rates are high, 8 to 10% doesn't sound so crazy, because you could get that on a fixed deposit at a legitimate bank. But just jump back 3 years ago, and interest rates were much lower, and suddenly a very predictable return of 8 to 10% a year after year after year after year for 15 years. Anything that performs at a few percent above inflation with incredible consistency, that stinks, Bruce. It's not even just smells a bit; it really stinks, because it's impossible that you can beat inflation or beat interest rates by 2 or 3% without taking material responsible risk. In other words, buying shares in companies or buying shares in properties, that whatever it is that you're buying, and those aren't going to perform in a monotonous, straight fashion. They're going to go up and down. Sometimes a volatile investment, something that moves in price, going up and down, a generic kind of general equity unit trust, it never goes in a predictable straight line year after year after year. I wish it did. It would make my life a lot less stressful than it is, but it doesn't do that. And that's actually a good thing. That's a healthy sign. An investment that's giving you a few percent above inflation or above kind of nominal interest rates that you can get on savings accounts and fixed deposits, and it does it every single year, rock steady, the biggest red flag of them all. And especially then you add all the other things we've spoken about, that's kind of the big red flag, to be very honest.
And the fact that it was in a trust structure, something Simon Brown at Just One Lap was saying earlier, that's the dodgiest signal of the lot. And and because this thing isn't actively marketed, I've not found any advertising for it. I've not found any promotions for it. I'm not seeing any sort of Facebook post of saying, "Oi, geezer, give me your cash." I'm seeing none of that sort of stuff. You've got to assume there's a network effect that played some sort of role here, whereby word of mouth people were sort of drawing others in and doing the work for them.
So that's probably the easiest part for me to understand, because that's just straight psychology. You create scarcity, creates the sense of being in a club, create the sense that you're getting access to something that everyone else can't get. There will be an element of secrecy about it, because you can't tell everybody, otherwise the returns won't be there anymore. So get your money, and then you're allowed to invite one or two friends in. They feel incredibly privileged, so they bring their money in, then they're allowed to invite one or two friends. So that psychology, even the car companies use it. They launch a new car and they say to you, you can't get stock of this car for the first year. There's no stock. They create scarcity, they create this sort of anticipation. So that's generic kind of basic psychology, but the lack of transparency of the investment inside the trust, that's a big red flag. You need to know what you own, and if you can't understand it, and there's no disclosures and nowhere to see kind of transparently what you own, wow, like red flag again. Just so many red flags, and the basic psychology of all of us being trusting, all of us fear of missing out, wanting to get growth, not wanting to see volatility. This kind of ticked all the scam boxes, and I can't see that it missed any of them.
And people still put money into it. People still put their hard-earned money into it, and no doubt people are being wiped out in this bloody mess. And it's shameful, and it's catastrophic for the people who've been caught up in it. In a moment, Warren, let's change tack. I want to talk about whether this is the time finally to take money out of the stock market as stock markets fall, and we've seen the JSE today below 70,000, and put it into a high interest rate account. It's beginning to smell like interest rate increases are on top of us again. We've got the US economy, which is growing at the best levels in 2 years, 4.9% growth in the third quarter of this year. Even though there's a risk of recession, there's a fear of inflation, and we've got those inflation fears just won't go away, particularly here. Today's PPI number, producer price inflation, on top of a worse than expected CPI number a couple of weeks ago, are going to get cages rattled within the Reserve Bank. Maybe we see a rate increase, maybe we don't. I don't know about that. But is it time to go into a fixed deposit? That is something we need to talk about in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So, Warren, fixed deposits versus the stock market. Stock market's in sharp retreat. Nobody's making any money. It's all panic, panic, panic. What do we do?
I love this question, because when it comes up, it becomes kind of the opposite of a sell signal. It becomes a buy signal, because when collectively people start to exit the stock market and start to move their money to cash, it's called capitulation. It means that they believe that that's the last time shares will ever make money, and therefore they sell their shares, offering often very nice, fantastic companies at a huge discount. And capitulation is always the last stage of a stock market downturn. The next thing that happens after that is the stock market starts to go on a tear. It shoots up, and sometimes it could be over months, and sometimes it can be over years. So if you're asking me this question, you have to know I'm smiling on the other side of this microphone, because maybe we're at the end of the bad news and the good news is around the corner.
Or maybe we're just at the beginning of the bad news and worse news is around the corner. That's always the risk here, isn't it? Which is what makes it so blimmin' difficult.
So the short answer to that is, please don't time the markets. Don't now, listen to this segment and go, okay, Warren said it's the market's going to boom. I'm going to, borrow money out of my bond and take money off my credit card and put it into the stock market. I'm certainly not saying that. I think it's important to understand that valuations matter. In other words, the price that you're going to pay for these businesses on the stock exchange, if they are low, if the prices are cheap, if these businesses are high quality and trading at good discounts, it tells you that you can buy them, and you might be wrong that you buy them a year early or 2 years early. But if you buy them and you sit back and you do nothing for the next 5 or 8 years, there is a really good chance that you're going to make very good money, including the dividends that these companies are going to pay, even if you were out by a year or two. So I think I wouldn't worry about the timing so much, but I certainly wouldn't be borrowing money to do this. And maybe to bounce to fixed deposits, if I did a quick search on what's the highest interest rates I could get from banks at the moment on a fixed deposit, and it looked to me around about 10%.
That's a good return. It's guaranteed. Isn't that lovely?
It is a nice return, and understanding that your only real risk is that the bank that you put the fixed deposit money with goes south, and our banks are very well regulated by the Reserve Bank, most of the time very prudently managed. So the risks of actually losing all of your money are incredibly low. However, you need to understand that interest creates a tax problem for you, and it could be anything from 2%, if you're earning 10%, you might be giving SARS 2% of that, or up to 4.5% if you're a very big taxpayer. So suddenly your return's not so good, and then you take off the impact of losing buying power of your money, in other words, inflation. And my simple math tells me you're in a position, if you're a big taxpayer, that you might well be seeing the buying power of your money eroding, in other words, going backwards by 0.5% a year. Or if you're a low taxpayer, then maybe your buying power of your money is growing by 2% a year. That is not so exciting to me. If we look at the stock market and you look at the taxes that you'd pay there, it's called capital gains tax. It's probably 18% if you're a really high taxpayer. And then we look at the returns that you get from the stock market. It's anywhere around kind of 11 to 13% or 10 to 13% over long periods of time. The likelihood is you're making around about 2 at worst to kind of 4% above inflation. That sounds to me like a much better return, especially because I'm not paying tax every single year. I'm only paying tax once when I sell the investment. So simple maths for me, Bruce. I can't do complicated calculations. I went to government school, and to me, my simple math tells me this is a great time to be buying shares, not a great time to be investing in fixed deposits, unless you're never going to pay tax. Maybe then you lock away some of your money in a fixed deposit and enjoy the return. But I do think that the stock market is always rewarding to investors with patience when they buy in at a very low price, and below 70,000, that's a low price.
Then we move on to a question from Robert, who is making it a little bit more complicated because it's kind of on the same theme. This is a theme, though, about something called structured products or products with guarantees. This is where you are told that if you put your money away for a 5-year investment term, we will pay you X amount of interest per year guaranteed. Now, that becomes quite attractive for people who are risk averse because they're not going to get the full 10% that you found. They may get 8%. They might get 8.5% guaranteed to them over the next 5 years. Robert wants to know if that's a good idea.
My short answer is I don't like these. I never have, especially the ones that have a 5-year term, and a couple of reasons. One, I did look at the blessed brochure that Robert sent us, and it was more than 30 pages. Now we spoke a little bit earlier about understand what you buy, understand the transparency, be sure that you know what's going on. There is no way I'm saying Robert's trying to punt us a scam. He's not, but there's no way you can tell me that you'll understand all of the terms and conditions of an investment when just the brochure, forget about the application form and the prospectus and all the other things. If the brochure alone is over 30 pages, you've got a problem. You already can't guarantee yourself that you know what you're buying. So that's my first problem. Now we've got a transparency issue. So there's a guarantee. The guarantee is all good and well until things really go wrong, because then all of a sudden, if your investment loses a bit more than 30%, well, sorry, you've got no guarantee. Then it's just tough luck, and you take your knocks like everybody else. So actually, we're only really guaranteeing your money within a little bit of a range, in the range that suits us. In the range where actually it suits the person issuing the guarantee. And that's probably my other big issue here is, offering someone, a return over a 5-year period that's guaranteed of 8%. Well, most of the time buying a stock market index over a 5-year period would give you a return, as I just mentioned, kind of around 10 or 12% per year. In a much more transparent way, and if there are losses, you will know about it. But the worst that the stock market loses you over 5 years is probably only about 5 or 8% over the 5-year period. It's really catastrophic when you lose 30% in a year, but that's rare that 30% stays with you over a 5-year period. So, gee, Bruce, I'm not loving the fact that the guarantees actually aren't that helpful. They're only guaranteeing a little bit of a loss. Secondly, you do lock your money away. Thirdly, the return that you're getting sounds very attractive, but you're probably going to get a much better return just buying the all share index in a normal exchange traded fund or a normal unit trust. Put it away and forget about it. And then my other big issue here is these are hugely lucrative products for the people that issue them. They're great for the insurance agents that sell them. They're great for the insurance companies or banks that take the money. And always ask yourself the question: why would a bank or an insurance company, product issuer, give you all of these guarantees and all of these structures and this really complicated thing if it was the best thing ever? Why would 60 billion rand unit trusts exist if this is the answer to all problems? The reason is it's not the answer to all problems. There are lots of terms and conditions and lots of catches here. And so psychology wise, I understand that we like investments that, where we've got some kind of protection. We like the idea of someone saying, don't worry about it. We've got this. We'll look after you. We'll give you a return. But they're not really looking after you when it really goes wrong, when you really need them most. It's a bit like your car insurer saying, I'll protect your car from theft and all of these things. But gee, if it gets stolen, in your house, in your garage, then no, I'm not protecting you anymore, and I'm not going to protect you if it gets stolen from the fancy shopping center when you've parked it in a locked bay. And so actually, they are protecting you, but they're not. In which case, kind of useless. I'm not a fan.
Warren Ingram, unequivocal and clear on both points, as we like. Thank you very much, Warren Ingram. Thank you for clearing up BHI. Thank you for the red flags warning there. If you've got anybody in your family who's got money in BHI and you want to talk to us, please get in touch. You know the numbers on 021446 0567 011 883 0702. And also to Warren, shares versus cash, shares and shares only. And to Robert's question on 5-year investment terms and guaranteed products, Warren, not a fan. It may give you comfort, however, Robert, to do it, but understand the intricacies of what Warren is telling you.